So, yeah, we're going to go over. We always start off by going over the S&P 500 chart because the stock market. I mean, the S&P usually tells where most of the stocks will be going. We are basically at the top of our trading range. We have this channel we're following. We had a lower high, lower low for quite a while. And as soon as we broke out of that, like right there, we noticed that we started to go in an uptrend. So we're approaching the 200 and 100-day moving averages and the S&P. And that is super good if we can get above that, because that is basically momentum for the stock market and for stocks to go up. Right now we're overbought. So that means we're at an 86 on a stochastics. We follow this, what's known as stochastics, to measure the amount of overbought and oversold in the stock market. Whenever it gets above 80, that means we're overbought. When it's below 20, that means that we're oversold. And we are actually in a position where we've been overbought for a couple of weeks now. And let's look at the last time we had this kind of situation. Let's look at full screen. Okay, this is the crash of the pandemic. You can see that we had this overbought situation for a while. We were down 30% this year. So we had a time when we had this overbought, and we also have that overbought now. We don't know how long it's going to be overbought, but there's a good chance that we like to put in new capital when we're oversold and everyone's selling. At this time, we're at a position where everyone is starting to lose their fares, and they're starting to put money back in the stock market. So it's, in that sense, it's a little more, you have to be more cautious in your approach to the stock market. So we've been following this pattern of higher highs, higher lows. We've been kind of going up against this top of this line. We're going to, at the end of today, we're probably going to be at the top of the channel. Usually what happens after this is we go to the bottom of the channel and up the channel and progress like that. So so don't be surprised if, some news story comes up that we go back down. But in general, the trend right now is up, and if we get above this 200 and 100-day moving average, we will be in a good position to have higher highs and higher lows. All right. So let's look at our calendar. Right now we're to 12, and just because we're overbought, the red means that we're in an overbought situation, and it's not a time to be heavily buying things, dollar costing into things. We like to buy whenever everyone's selling, and we like to dollar cost, put money in whenever everyone else is selling and things are out of favor. We do have the seasonal factor of the end of quarter window dressing. That's in the end of September. We know the last Fed hike will be on the 20th of September. It'll be like 75 basis points. So all this fear of the Fed should be over then. We could have a relief rally from that. So we're looking forward to that. And at the end of the year, seasonality, December and January are some of the best months of the year, and November is too, actually. So if you're not invested now, I would use this time, of August and September are some of the worst months of the year seasonally. So this is the time to start dollar costing into positions. And knowing that most likely towards the end of the year we're going to have decent time. Okay, I'm going to go over quickly some of our talking points. Inflation is definitely cooling off. We had gas prices, number one on everyone's mind. The importance of gas prices going down every time you look at them means the consumer has more confidence. They'll have more money in their pocket. They're going to spend on things that they don't really need rather than food and gas. So the CPI came out this week. That's an index that says how the prices changed, and basically the prices are unchanged. And inflation is about 0.3% according to that report. The gas prices are down 7% in July, 80 cents a gallon, and treasury yields are going down. So you see, the good thing is that September 21st is going to be probably the last rate hike. That's going to give a big relief to the stock market, which was worried about slowing the economy down and slowing the consumer down. You see, the analysts are going to be cutting estimates, and we're looking at this time right now of August, September as cutting estimate time. So as these earnings estimates are cut, you're going to have stocks going down, and right now we don't have earnings until later on, maybe in October, to get us out of all this. So right now we have to rely on good earnings reports and good news from the Fed. Right now, there's a couple things that you consider. The Fed is reducing the balance sheet, and that's really bad for the stock market. That means they let a lot of their they have $9 trillion on the balance sheet, I think, and they have to reduce that, and that slows the economy down. So the core rate of inflation is falling, and employment is still good. We have a strong labor market. Earnings are better than expected in general this earnings season, and this because of the lower gas prices. That's going to drop kick the consumer to spend money, and that's going to be good for the economy and for the stock market. So we have catalysts for market to go up, and we have catalysts for market to go down. This week, we had some news on inflation. It is getting better. It's there. It's still there, but it's getting better. So the CPI rate is falling. Inflation is down to 8.5 from 9.1, and of course gas prices is going down. Let's look at. Okay. This is CNBC pre-market data. I look at this all the time. That gives you a good idea of foreign exchange rates, gives you price of oil. I like this screen a lot. Oil is down again, minus 2%. So we're gonna see the oil companies going down lots, and that could be because there's a lack of demand in a slowing economy, or an oversupply. We don't know. So let's go back to our talk here. Okay, catalyst for market to go down, to go up, is a reduction of oil prices. I don't have that here, but inflation getting better. You see, an oversold market. Right now we're overbought. So there's a very good indication that, we're in a relief rally now, but we're going to have a situation in the next 2 months. The earnings estimates are going to come down for companies, and that's going to make the stock market and those stocks go down. Just because of the slowdown in the economy. But there's a lot of people that say that the stocks are pricing in, they're not, the estimates aren't pricing in slowdown yet. So as soon as those estimates come in, we're going to get a hit on the stocks. So let me see. Other things, earnings announcement. there's no updates to any of these this week. We're not going to have any earnings for another couple months. So we can't count on that to make the market go up and down. You see. So we concentrate on, in general, the stock market because every stock we're following kind of follows the S&P. And let me see. Regarding China, China says they're not going to be attacking Taiwan, and they don't want a big war this in the near future. So that was good. So that could help the market. You see. Okay, so right now we're actually concentrating. The stock market is concentrating on the reliable compounders that have been hit. The compounders are the stocks that I brought up our meeting notes from last week. Compounders are the stocks that are held by the big mutual funds. These are good examples of stocks you can buy and hold and not look at. And they grow 5 to 15% or more a year. And you know whenever they hold them and they don't sell them, and these are smarter people than us, that's probably a good idea to have some of those in your portfolio. Okay, so you see. So right now, the stock market is concentrating on those stocks that have pricing power, that they'll do good in the good and bad environments, and that are compounders. And that's why all the big tech stocks, the FANG stocks, went up lots in the past month because people are just rushing to get into stocks like Google that are down 30%. Right now, Google's down 20% on the year, and there's a lot of people catching up and trying to get into the good ones. So now, major variables in the stock market: oil, Treasury, and inflation. Inflation went down just a little bit to 8.5%, and the 10-year Treasury this week went up 6%. So that's bad for tech stocks. That's another reason why the tech stocks, the leaders of the stock market, might not be doing good. If the Treasury goes up, that's bad for tech stocks and stocks that are dependent on borrowing money. And the price of oil is good. When it goes down, it's good for the stock market, but when it goes up, it's bad because of the input costs for a lot of companies. It's hard for a lot of companies to pass that cost on to customers, and they'll end up making less money. So there's a lot of red flags that tell us the stock market's going to go down because the treasuries are going up and the price of oil went up. This was as of this morning, and it went down 2% today. But all right, so let's keep that in mind. Let's look at the sector ETFs to see what sectors are doing good and bad today. I'm expecting oil to be down. Let's see. Oh, almost every sector is up today. Energy, oil, right? Those are down because the price of oil is down $2 a barrel. The ones that are doing good: gold miners, metals. I don't know why. Home builders. Okay, so we had in our meeting notes. The Fed futures say that the Fed will lower rates mid-2024. There are actually securities that people gamble, or not to gamble, but they predict when the Fed will start lowering. And we were talking a month ago about how all of these home builders were hit 30-40% down, and they have PEs at 4 to 5 PE, and that's an example of a sector that was oversold, and now there's an end to this interest rate hiking next month, and then it'll be reducing the rates, and people will start buying houses again. So that's why the home builders might be doing better. We had a bad, there's a couple bad reports about, like Lennar had a bad report today for, their estimates, but I guess I would expect them to be down if one is downgraded, the other ones usually follow, but they're not always right. Okay, so what else is going up today? I expect technology to be up there too. Where is it? Financials. Okay, so energy is the worst, and right now, technology, there it is. Technology is probably up 1.5%. Right, that's good. Let's see. Okay, let's go back to what we were talking about. Does anyone have any comments? All right, we're going to go back to looking at, okay, the S&P. Okay, last week we were we're still bouncing around on the top of the channel, and it's not actually going down to the bottom of the channel. We're just kind of going like this. So we're going halfway through the channel and going back up. And the magic point is this 200 and 100-day moving average. As soon as the majority of stocks in the S&P go over this 200-day moving average, that is momentum, and you can't stop it. It's like a train, and it just allows the stock market. Everyone's buying. There's momentum, and that pretty much is the end of this bear market rally, bear market situation. We were at lower highs and lower lows. All right. So now Treasury is up 6%. That's really bad for growth stocks. It's good for bank stocks. So I'm surprised it went up this week, but right now I think there could be a fear of missing out. So fear of missing out, that just means that if the stock market starts going up and it's an oversold condition, people just keep on trying to get in because they got out at the worst time. And that's why it's important to be invested at all time, because if you miss the best days of the year, then that's like most of your gain. Okay, fear and greed. We're getting to a point where we were extreme fear, a month ago? Wait. 1 month ago, extreme fear. People were fearful of the Fed raising interest rates. And every week we're getting just a little bit more confident. We saw that the VIX going down. We saw the stock market's going up. We're getting more greedy. And as you get towards this extreme greed, that's the time where it's either you sell or you don't buy, because it's the opposite of, it's normal. Let me see, let's look at. There it is. This is our emotional situation. Last week we had media attention. This could be it. On Barron's, we had a bull market returns article on the front page. We have this enthusiasm, fear of missing out. So we're in this phase right now where we're here. We're getting enthusiasm, fear of missing out. Soon we're going to be at greed. And then people are going to get carried away, and then we drop down to despair again. So be sure that you don't buy when it's up here, and buy when it's people are greedy. You want to buy whenever everyone's selling off, and no one wants to buy housing stocks because they're fearful about business or whatever. So the best buys are whenever there is little visibility and no confidence. And so we're starting to get our confidence back, and we know by looking at the fear gauge and the VIX, it's down to 20. Look at this. It's this is kind of the reverse of the CNN fear index. When people are greedy, the VIX goes down to like 14 or 13. When people are scared, the VIX is up to 30. So it's like an inverse correlation to the Fear and Greed Index. It does use the VIX in its calculations, but the key point with all this, we want to monitor the fear and greed in the market. We want to buy whenever people are fearful, and when people are greedy, we want to not buy and just watch things. All right, so the VIX is again down since last week. So there's no panic in the market now. Things are getting back to normal. People see an end to this whole malaise of the past, the bear market we've been in. So let's go back to the S&P chart. Stochastics. We've been riding at over 80 for at least a couple weeks now. So we're overbought. That doesn't mean we can't go higher. And if you're missing out, we could be following this top of this channel, going up and down like this, until we're fully above the 200-day moving average. And then once we're at the 200-day moving average, we're okay. Right now, the Fear and Greed Index is still neutral. We're going into the worst months of the year. So August and September are two of the worst months, primarily because there's no earnings during those months. It's just dead space. People go on vacation. There's not as much excitement, no volume. So with that, usually that's why I'm wondering why we don't go down to the bottom of this channel, but we're higher now. So you have to keep that in mind. Don't get overextended whenever people are excited. Now, here's an article I found. Any questions on any of that? All right. Here's an article. Apple is advertising the next big revenue generator. We know that Apple came up with all kind of rules for their app store. Their app store didn't allow personalization, keeping information about the customer, and that really messed up Facebook's business model. But they're actually hiring for an ad tech platform. So there's ads put out for, a lot of ads put out for engineers for ad tech. So they're putting a lot of effort into advertising, and that's really good. We know from Google and Facebook that it's very profitable, the ad business. And there's a very good chance that this ad platform is based around the virtual reality thing that they're coming out with. So key factor there is that that's additional source of income that's not factored in the current estimates. And they're always come up with something new every 6 years or so. So that's a really good reason to continue to hold Apple if you're an investor for a long term. Okay, next article that I came up with. Danny Moses. He's a guy that was involved in the Big Short. That's whenever the housing crisis happened. He basically played that and he made millions of dollars. He likes to look at situations and see negative things. Like right now he's short in Tesla. Like we were talking last week about how Tesla is super overvalued. Not super, but it's overvalued. Tesla is, Elon Musk is actually selling a lot of stock recently. Maybe for that Twitter situation, but when insiders are selling and you have overvaluations, yeah, it's a very good chance the stock is going to go down. And you see, he says that we're in the early stages of earnings cuts and massive layoffs. So when the economy slows down, you're going to have the analysts changing their earnings estimates. And that's why this month and the next month, that all those cuts are going to happen and stocks will go down every time they reduce their estimates for them. And once the layoffs happen, there's going to be less money going around in the economy because people won't spend if they don't have a job. So earnings are coming down, layoffs starting, and we've seen peak earnings, he says. So, as people get really excited and they're confident and they don't have fear anymore, they're greed. That's whenever all these bad earnings come out. And Walmart's saying purchasing power is diminishing, and people's wages aren't keeping up with our 8% inflation. So he's on the side where there are risks in the coming months that the economy is slowing. For me, looking at this, I know that we're very good chance that the stocks that I own are going to be returning like 0 to 5%. If there's a bad downturn in the economy, if the companies aren't going to go out of business. The consumers are spending their money on gas and food right now, and they don't have money on discretionary goods like maybe a watch that they like but they don't need. And this guy said people can hide out in quality stocks like Microsoft, Apple, and the FANG stocks because they'll hold their value and they'll trade a premium to historic valuations because they're like an oasis when other stocks can't manage that. So he also raised the flag that unprofitable companies will have a hard time funding their debt. Like in the pandemic time, we had companies like Carnival Cruise Lines and Norwegian Cruise Lines. They couldn't run their business because of the rules of the government. So they took on a lot of debt. And a lot of that debt's coming due. And once they have to renegotiate that debt, it's going to be at a higher level and they might go out of business. Or they won't earn as much. So he said, make sure that whenever you buy companies that they're profitable. Especially when you're looking at these tech companies like the startup car companies that aren't making money and they have to fund their ongoing business. And if you're not making money, then it's going to be harder and harder to borrow money to keep going. So that's a good video to watch if you have time. Okay, this article is pretty interesting. This article highlights stocks that are new buys at the best mutual funds. We've been keeping track of some of the largest mutual funds and what they've bought and sold. For instance, Magellan is one of the most famous and one of the biggest mutual funds. And we looked at 2021 versus 22, and we see there's a couple changes. They added NVIDIA, Netflix. They sold Procter & Gamble and Visa. And we did that exercise for some of the biggest ones like Fidelity, but we noticed that they're keeping a lot of these. And that gives me confidence when I hold the ones that aren't sold here, that I can buy and hold that, and someone smart is doing the same thing. And I do that same thing with Warren Buffett. Whenever he buys Apple and that's half his portfolio, I have a little bit of confidence that I can hold that too. All right, so this article basically says what the new buys are for mutual funds at the best mutual funds. So the stock mutual funds that are performing the best, they said which ones are buying, what stocks they're buying, and they made a list. So Apple was one of the ones that recently they've been buying the most of. Microsoft, we've already been following those, so we're not going to go over that again. Here are some of the ones that were on the screen that they were adding to. And what I did was I went through just the feasibility of each of these to see if these are worth following. And let me see. Okay, one of these stocks is United Health. And one was Elvin's Health. Did anyone ever hear of Elvin's Health before?
No.
Elephants what?
Elvin's Health.
Oh, elephants.
Yes.
Pebbles.
Did anyone ever hear of Anthem Health?
Yeah.
Yeah. They're
Is that an insurance company?
Yeah. They do health plans. Like we have Aetna. And Elvin's Health used to be, they were, well, anyways, I'll go over that later on. But it's interesting. United Health, Elvin's Health is actually bigger than United Health, and they're in the same business. So I said, let's go into a deeper look at this industry, because if they're being bought up by the best mutual funds, there might be something to that. Like there's some sectors that are down. We had the home builders; they were all down 30 or 40%. It's a big, when we reviewed them a month ago, and we said, well, let's look at that sector, and if they're all down, maybe there's some good ones in there. So we have two themes in this list here of purchases of these mutual funds. One is drug stocks, and the other is healthcare stocks. So in these ones right here, I tried to do a understanding of them, and they didn't meet our criteria. So we're going to look at these drug stocks and the healthcare stocks just real quick. We already looked at United Health like a couple weeks ago. We had this article that their revenue is up 13%. We did this annual earnings estimate. We saw they were growing at 13%, and their PE is a lot more than that. So their PEG ratio, so they're like almost 2 times overvalued. And we were noticing that they had a steady earnings, the total earnings, they're going up in a straight line like that, and their PE was pretty consistent with their history. So now let's look at some of the other ones, though. Some of the other ones on this list. These Elvin's Health. Okay. Elvin's Health. All right. So I did a quick map of their. Hold on a second. I got another document here. Okay. Right. What are horses? Okay, here it is. The Elvin Health earnings estimates. Okay, so I saw them growing at 12% when you look at the E-Trade estimates, consensus estimates. So they're growing their earnings at 12%, and their PE ratio is 16. So that they're the most fairly valued of all the ones we're watching. So they're a health benefits company. They used to be called Anthem, and they were bought out. They were renamed or bought out, I forget. But their PE is 17. Bank of America says they're growing at 12. That matches, what we saw. And they have a dividend too of 1%. So we looked at Morningstar. Morningstar says their fair value is 10% less than where it's trading at. So they think they're overvalued by 10%. And CFRA said they are overvalued by 20%. So this isn't that exciting. It's good to go over these things. They're selling at a premium right now. Like maybe PEG ratio. So they're selling between 10 and 40% overvalued. And the reason why we go over these things, even though they're overvalued, is whenever the stock market or this stock in general, if it goes down, it'll probably go down to a PEG ratio of 1 for news or whatever reason. And we got to be willing to jump on it or start putting money into it if we want like a consistent return of like 12%. And So this one isn't that exciting. It's not on sale. Here's what the note was on Morningstar. Despite a weak, oh, that's the wrong one. What did Morningstar say? There was no comments on Morningstar, but CFRA said, okay, so it's selling at a premium to its historical PE average of 15. So it was what CFRA was doing. It was looking at its PE ratio throughout its history right here. You can see that if it started trading at 10 PE, 10, 17, 13, 15, now it's at 18. So there's a very good chance that if it's trading at a PE of 18 now, it'll eventually revert to a mean of like 14 that it has been through its whole history. So that's one thing it said. So its valuations are somewhat on the high side. That matches what we're looking for. And risk associated with higher acuity due to deferred care during the pandemic. Okay, so what happened, one negative for this whole industry, maybe that's why it's selling off, people didn't get care during the pandemic because there were rules, only emergencies allowed. Now they're doing these procedures, like replacing a knee or something that they put off during the pandemic, and they're incurring all kind of problems, all kind of expenses because of that. So that's why we have a lot of these stocks, being on sale compared to the normal averages. So that's one bad thing. You see. Okay, so they're going to have some people getting elective procedures they did during the pandemic, and that's going to cause them to have problems. Okay, so let's look at another. Let's look at Eli Lilly. The Eli Lilly. Let's look at our meeting minutes. On one. Okay, Eli Lilly. I did a calculation. Let's look at the calculation of what. Hold your breath. I'm on to something. Okay, I did a calculation for Eli Lilly. 50%, 23%, 23% in this annual earnings estimates. Okay, that's pretty good. 23. Basically, what they're saying here is they have an Alzheimer's drug. Maybe that is going to give them some kind of growth in the next couple of years. Right now, the PE is 37. So if they're only growing at 23, the average growth is 23, the 4P is 37. That means they're 1.6 times overvalued. And the catalyst is the Alzheimer's drug. If that actually works, that's one of the biggest unaddressed markets in the world right now for drugs. So we'll watch this stock, right? But this stock also has some other negatives, like pending litigation that I'll show you later on. This is Bank of America's estimates. They say its PE is 47. It's really okay, and it's growing at 14%, and that's lower than what we saw in this our earnings thing. The E-Trade analyst consensus estimates. So if it's 14, they're only growing at 14%, then it's 2 or 3 times overvalued. So it has its 1.29% dividend. You see, Morningstar says despite weak quarter, Lilly is positioned for long term, but stock is priced for correction. That means that matches they think it's 20% overvalued, and we're saying it could be 2 or 3 times overvalued. But one good thing is, let's see, the earnings seem to be steadily increasing. It's inconsistent though. Look at this, 3, dollars, $4, 2 negative 4 3. Okay, so that's not negative. That's not very good. We'd like to see at least going up in a straight line. Revenue isn't even going. It's not very consistent. So let's look at other things here. Okay, and we look at the profit margin. That's good. Return on equity is really good. So with Eli Lilly, there's a lot of consistencies there. It's overvalued, and I think we have to wait for it to have a PEG ratio of 1 to really get a position in that. Not that exciting right now. But if they have an Alzheimer's drug that takes off, it could be super undervalued. But right now the estimates aren't pricing that in. So, let me see. That was an interesting exercise. We looked at ELB. Let's look at ExxonMobil, another one of these that they said the mutual funds are buying lots of. That could be because of a momentum play. Exxon is one of the most unstable stocks that I've seen in a while. That's because its earnings are based on the price of oil, which is unpredictable. And you can see its earnings estimates are scheduled to go down 10% a year for the next couple of years. So this is not something that would pass my test of what I want to put my money into. But if you want to diversify, I think the reason why most of the mutual funds bought this is a momentum play. Because this is the only thing that's going up this year. And they'll probably get out right whenever everyone else is missing. Let's look at, hold on. Okay. Yeah, this is the S&P. Let's look at the energy select. Okay. I guess the funds were seeing that this energy sector was the only sector that was going up at the beginning of this year. So they probably jumped on the bandwagon for a momentum play. But we saw right here when it got out of that channel that we're out of that uptrend. And so now they're probably stuck with this energy play while we're rotating into tech instead. So I would say that's not something that needs something we'd be interested in for a buy and hold, because look how inconsistent this is over time. I own some of it just to get diversified, but I'm just saying that this is very unreliable. Let's see. Let's look at CLAC is another one of these that they mentioned as a high conviction buys by mutual funds. Okay, we see that it's going to go down in earnings next year. I don't know why they. Okay, that doesn't make sense for us. Let's look at CLAC's valuations. Its PEG ratio is 1.69, so it's 69% overvalued. So Yahoo Finance thinks it's growing at 10%. Doesn't look like it's growing. It's losing 5% for the next year. There's not much visibility. It's only going out 1 year. So this is KLAC is, I think they make semiconductor parts. So they make all the parts for the semiconductors. So right now the semiconductor industry is taking a hit because of maybe oversupply in inventory. So let me see. Profit margins are good and their return on equity is good. But this just kind of scares me. It's not going up in a straight line. We want stocks that are going up. And all right. So the other thing I wanted to say here is we're done in July. We're now in August, which is typically not a good month of the year, and September is even worse. So we're not expecting that much, and that's why we think the at least we have it's not going to really go anywhere unless we have a fear of missing out rally. Let's see. Let's go back to where we were. There it is. Okay. So we're going to have 2 months that are so-so, and then we have the end of the year Santa rally to look forward to. So I would say if you're not invested, use these months and the down markets that come with it to buy a little bit at a time. And that is okay. So, any questions? Anything anyone wanted to go over? Okay.
No, that was good.
Oh, great. Well, I got one more thing to do though. We have 5 minutes. I think we can go over some of the market movers. These are stocks that are going up and down today, and we'll look at why. We thought oil was down 2% today, the price, the commodity. And with that, we have top decliners. We have a lot of oil companies in that. So we have, let me see, hold on. Let's look at okay, the energy sector. Okay, so now we can see that oil is becoming out of favor. Most likely we're going to start seeing lower highs, lower lows, and that's in a bear market now. And I guess rationale for that is if the economy is slowing, there's less oil demand, and the price of oil goes down with that. So that makes sense. That's why it's important when we saw this uptrend break right there that you're not overloaded in oil stocks. All right, so let's go back to this. What's moving today? ON Semiconductor. Actually, if we look at our meeting notes, I didn't notice at the time, but one of these stocks that the mutual fund was buying was ON. Let's look at that. I didn't look at that. From last article, our new tip sheet. All right, these are the stocks that the mutual funds bought the most of. So ON Semiconductor. Let's look at that. Because okay, ON. Does anyone know anything about ON Semiconductor? All right. It's not a very big company. It's a $28 billion company. Okay. It's PEG ratio. Look at that. PEG ratio is 0.87. So according to Yahoo Finance, it's 13% undervalued. Let's look at if it matches anything else. Well, look at that. Profit margin is 22. Return on equity is 37. That matches those two. And let's look at the earnings estimates for that. I think these mutual fund people, they're pretty good. Okay, so we're going to do ON. Earnings. Okay, so that's okay. I see inconsistency here. We have $5 earnings this year, $4.93 next year, $5.16 the year after. So that isn't that much growth. So that doesn't match, our expectations. So that was a good exercise. Let's go back to this market movers. ON's, that's up 8%. Broadbridge, Penn Entertainment. Penn is a gaming company. Albemarle, they're lithium. And Applied Materials, semiconductors. So it's semiconductors, and then Generac is the solar power roofing company. Right. So we have the themes there. Let's look at the NASDAQ. Semiconductor chip companies. NVIDIA. Okay, a lot of chip companies are in the top gainers. They've been out of favor for quite a while. Maybe it's just turning around now.
I saw something on the news. Oh, sorry to interrupt you. I saw something on the news about something about. I think Biden was doing something, trying to like basically upscale America's production of chip companies, or like trying to push it. I don't remember what it was. I didn't really pay attention to it. I just caught a glimpse of it.
We did have a chip bill that was passed. So the increased the that decreases the reliance of America on manufacturing of chips in China. So domestic chip production bill, I think it's called, something like that. So that could be a catalyst for a lot of these semiconductor companies to have more business because they don't farm it out to China as much. You know, if you have all that in America, that could make sense. It took a couple of days because that passed a couple of days ago. But one interesting stock that has not done good, even though we have the potential of a lot of business from that chip. Intel has been down so much. Let's see if it's up with them. Only 1%. But look at this chart of Intel. We were talking about Intel for, I think last year at this time, we were saying what was better, Intel or Taiwan Semiconductor? Rats. Did you hear that? Oh, sorry about that. I got an ad. So I can't.
I didn't hear the rats.
Oh, okay. In that case, I'll try it again. I got an advertisement. All of a sudden, Yahoo Finance is advertising with found. Okay, so we're going to look at Intel. Chart. It's only up 1% today, but look at this chart. It is down so much. So basically, Intel's problem is they failed to innovate, and they're losing business to AMD and NVIDIA, I think, in the data center. And what they're doing right now is they're putting together a way to make chips for other companies in America. And they counted on this bill to allow them to do that. So they're switching their business model from, producing their own chips to producing other people's chips and mass producing, I guess. So, but look at so they're not going up with the rest of the chip stocks. That's interesting. Let's look at their valuation right now. Their valuation their PEG ratio is 5. So that means their forward P is only 14. That must mean they're growing at like 3%. No wonder they're down. Let's look at Intel. Hold on. NTC. That's a good thing we chose Taiwan Semiconductor instead of Intel last year. Okay. So let's look at the earnings. This is a big company too. But the analysts only look out the next year. That's weird for a big company. Let's look at the 2.27 divided by 2.68. Okay, 15%. They're scheduled to grow 15% between this year and next year, but there's no beyond next year, which is interesting. So it's not going up with the rest of them. It doesn't look like that's this stock that's going to be growing. There's just not a good clarity, and the analysts aren't giving estimates beyond next year. It's kind of hard to value something like that. So that's why it's like a it's something we can't rely on, I guess. So it's a good thing we never invested in that. All right, looks like I came to the end of my talk. If you have any questions for next week, let me know, and I'll cover that in the next week's talk. And thank you for attending. I hope I didn't talk too long. And we'll see you all next time.
Perfect. Thank you, Greg.
All right, thanks.